Let's go to Chris Conway from the Australian Stock Report. He's live on the wall. Chris, welcome into the show. To you on a new day, a new sort of sense of we are debating this one, and so join the Macquarie discussion if you will. You know, there was references Tony made to the $1 billion. How do you see that cash pile sort of now being deployed in the right direction, or you're a little disappointed?
Good afternoon, guys. Look, you were just talking about the spectrum of, bulls versus people who've got an outright sell on the stock. I would think I fall somewhere in the middle. It's trading near 100. I don't think there's too much more in it in the near term, but by the same token, the very next sentence out of my mouth is that I don't think it will fall away sharply either. I agree totally with Tony's point that returning $1 billion to capital, it alludes to the fact that Macquarie themselves might be finding the investing environment more difficult. And if we look at what's been the engine of growth, again, Tony's exactly right. It's the real assets and infrastructure business that has been the engine room for Macquarie for, well, the last 10 years, really. But, a couple of things have happened in the last few years. Asset prices have surged. There's been more competition in that space. And there's also been funds flowing away to more passive style of investing. So, again, like I said, it alludes to the fact that Macquarie themselves may think the environment is becoming more challenging, and rather than invest that capital and run the risk, they'll return it to shareholders. So, like I said, there's that side of the equation, but then, they do still have a pretty strong pipeline, and I wouldn't think that this is going to fall over in the next, 2 quarters.
All right. Putting it alongside, say, a CSL as well, with offshore interests, Tony, do you sort of like the more targeted, unknown entity that CSL represents? Because a lot of this is Macquarie's financial wizardry. You have to sort of be in that league to really make sense.
Firstly, to Macquarie, taken advantage of a great opportunity, which is a low interest rate environment, and they've done it in a unique way, and they absolutely dominate in sectors that have done phenomenally well, being infrastructure in the past couple of years. Switching gears to CSL, clearly a different sector and a different business, but I still think that there's an enormous amount of runway and growth for additional products to come to market, particularly for haemophiliacs, and obviously the return to form of the Seqirus and the actual vaccine business itself, which is, again, a world's second largest vaccine business. So one of the themes you're picking on, though, which I do think is an important one for investors over the next couple of years, is if we are to get a higher rates environment in the United States, it should logically translate to a lower Aussie dollar. There's a raft of opportunities and great stocks to be long on that you want to take advantage of. Now, CSL is one of those, but there's many, many companies on the exchange, be it those that are sort of very heavily exposed to the euro as a currency, the US dollar, and so forth. Bottom line, if you're expecting the Aussie dollar to come down against any cross-currency, then some of these stocks, including Macquarie, are great opportunities in a portfolio. They provide a superb amount of buffer. And one last thing on that, international equities or those exposed offshore, we typically find that if markets do get stressed, while you might get a decline in the underlying index, you tend to get something of an offset by way of a decline in the Aussie dollar. And that actually provides a really nice buffer. You get growth in good times and higher rates environments, which we're likely to head into for international shares. But domestically, you get a little bit of buffer if things start to get a bit messy. Not
really a help if you're on the Woolworths register, though, is it? That currency story. In fact, life gets harder as the currency gets weaker. Because a lot of it's imported.
Yeah.
Isn't it?
Well, actually...
Well, I mean, yes or no? How do you read it?
Yeah, I think switching gears just quickly here. On Woolies, you have to think that the CPI environment isn't going to help them in terms of their ability to price in a competitive price environment. Declining food prices, those two things are really making it very difficult for them to achieve decent margins in the supermarket.
And they're not
business.
alone because, I mean, Chris Conway, you had management at Wes pretty much stating it for what it is for the two incumbent oligopolists. Deflation into Q1, stand by for it. Expect nothing less.
It's a race to the bottom. It was only recently the Wesfarmers reinvested chasing Coles, on price. Deflation, price deflation, particularly in fresh produce, is going to be something that I think will stand out in the Woolworths results tomorrow. I guess what they're hoping for, though, is that the momentum that they've gained previously on competing in price and refreshing their stores and some better execution on that front will be enough to overcome the price deflation. Looking for sales growth of about 3% there. Big W, still a big problem. You know, Target keeps dropping prices. They have again invested in price and merchandise, but it's going to take some time for that story to flow through, probably at least a couple of years. And like-for-like sales, we'd like to see that above 5%, just to show that the Woolworths turnaround story, or you know, realignment, I guess you'd say, is moving in the right direction.
Mm-hmm. But I mean, Tony, how would you rate any of that happening? I mean, turnaround.
Look, a lot of it's already baked into the share price, and to be fair to the new management team, it has been a pretty significant turnaround. You know, if we go back almost 12 months, Woolies was largely viewed as having won, in inverted commas, the Christmas battle. They're getting market share, or at least stabilising market share. The only thing in the background, in my mind, with the supermarket side of the business is the store refurbishment program and the
glossy,
capex.
aren't they? The stores are glossy. I mean, who wants to go there? Where's that turnaround?
Well, that's the thing. You know, as you're investing in these new stores, a tremendous amount of capex, and if you're operating at wafer thin margins, you've got to have superb operational execution. So there's some headwinds there, as we're just talking about too. Big W, I can't see a reason. I really do struggle with that side of the business. To be fair, Target's no better as well. I think there's only room for one DDS in Australia, and that's Kmart, and obviously Wesfarmers have it. You know, and then you've got the relic of Masters, as it were. But look, for mine, I think Woolies is just a good, solid mainline retailer in the process of a turnaround type story. Is it going to be a stellar returner in a portfolio, though? No, I don't think it necessarily will, although I think the vast majority of the worst is behind it.
Okay. Chris, the vast majority, or perhaps you ain't seen nothing yet of the worst for Telstra. How are you reading this one now, according to a pretty grim far side chat with Sissy and their researchers?
Yeah, so City Note this morning talking about a potential 600 loss of earnings from the mobile division. And they point to the fact that, you know, the market in mobile and broadband is maturing at exactly the same time as competition is intensifying. I think Telstra's mobile revenues peaked, or market share peaked, in 2014. And a lot of that, they suggested, was due to the fact that other networks had issues. So Vodafone is one, obviously, that springs to mind, when they had all their network issues. And subsequently, that market share was higher than historically it would be. They further posit that if it returns to, say, 2011 levels, which is about what the average would be, there's that $600 million at risk. So, you know, it just goes from bad to worse with Telstra. The question was, Carson, is there more downside to come? I would think so.
Right. Okay. Do you see it in quite those terms, those stark terms, Tony?
Look, agree with all of those comments. I haven't read the note itself. The one comment I'd just say is that for the mobile phone networks, 5G can't come fast enough. The Internet of Things can't come fast enough to turn the story around and to force the adoption of new technology. And that's what they're missing at the moment. And this is actually not necessarily untrue of Apple and its new devices, the 10 and all that sort of thing. We need to sort of drive through to a step change that really forces people to upgrade or change the way that they sort of interact with these devices.
Because Andy's Penn was talking Internet of Things like 2-3 years ago.
Yep.
When he took the top job. I mean, why do we have Internet of Things then and still Internet of Things to come now?
Yeah.
I mean, what's happened in the interim?
Yeah. In Andy Penn's defence, it's pretty difficult to explain a concept when you can't really conceptualise. It's not in your living room today, right? And you know, there's a number of different angles. It's a bit like when Telstra talk about recasting itself as a technology company as opposed to traditionally it's a phone business, right? You know, that's what we think of it as. You know, cable TV, that was an addendum. The list goes on. But really, I think the business in the background is evolving a long way. Now, Internet of Things, you know, put simply, has the potential to produce vast amounts of data. It will be a very data-hungry system as well. And while it is some way away, I really think that the adoption cycle is going to be, you know, a fair way ahead of us. The bottom line is that it's going to take some time to turn around and become apparent to investors. But for right now, for those who want to sort of prophesise as what it might be, there could be an opportunity there. But to Chris's point, in the short term, we've got stagnating growth in pretty much a subscriber base and everywhere else.
Okay. And we won't be charmed by the Internet of Things to masquerade over that one. Thank you very much, Chris Conway. Have a good week.
Thanks, guys. Cheers.
All right.